FX Nation, what's up guys? Welcome back to the channel. Welcome back to another video. And of course, welcome back to our Trading with Market Makers 2024 week 12. So we've gone 11 weeks deep diving into the strategy, guys, giving you absolutely every single detail about the strategy, hoping that any part of this strategy will help you. So hopefully you've gotten a lot of value out of these 11 weeks. If you're new to the channel, hi, my name is Mark. I've been trading since 2011. And I'm just literally sharing my entire strategy for the last 11 weeks. So if you're new to the channel, go back to the very beginning of the playlist, FXM Mentoring 2024, and check out the strategy in the entire playlist. So I hope everyone's gotten a lot of value from the entire 11 weeks. 12th week, this is probably the most important video out of them all because we're going to go ahead and jump right in and we're going to break down keys to success. So let's get right into it and break this down for you. So when we talk about keys to success, basically I'm talking about principles to master. So out of all the videos that you've watched so far, this is definitely going to be the most important one to watch the entire thing because every single part of this video has major golden nuggets scattered all over it. So let's get right into it with the first thing here, and that is follow your trading plan religiously. Your trading plan is your roadmap to success. It's not just a set of rules. It's a structured framework that guides your decisions and keeps you focused. One of the biggest mistakes traders make is deviating from their plan, especially when emotions are high. A solid trading plan covers entries and exit points. It covers risk management. It covers how to handle different market conditions. By sticking to your plan, you remove emotional trading and stay aligned with long-term profitability. It's tempting to chase quick moves or exit a trade early, but success comes when you trust your strategy and stay grounded to the bigger picture. The second is discipline. Every day, every trade. What do I mean by that? So knowledge isn't enough to succeed. Discipline turns knowledge into profit. Staying disciplined means the following: not overtrading, waiting patiently for high probability setups, sticking to risk parameters even when a trade looks too good. Discipline is more than what you do during trade session. It's a mindset. I learned early on that you don't need to trade every day to be successful. Sometimes the best move is no trade at all. By exercising discipline on slow days, you avoid unnecessary losses and preserve your capital for when the right opportunity arises. Risk management is non-negotiable. No matter how skilled you become, risk management is your lifeline. Trading without managing risk is like driving without brakes. You may get away with it for a while, but eventually it'll catch up to you. So key elements of risk management: limit risk to 1 to 2% of your capital per trade. Use stop loss orders effectively. Understand your overall exposure and position sizing. Many talented traders have been wiped out because they ignore this crucial principle. The goal isn't just to win trades, but to stay in the game. Protecting your capital gives you the chance to profit over the long haul. Never let a winner turn into a loser. One of the hardest lessons in trading is knowing when to take profits. Early in my career, I've let winning trades run too long only to watch them turn into losers. Don't make this mistake. Lock in your gains when the market gives them to you. A solid exit strategy is just as important as your entry. Know when to scale out or tighten your stops. Use trailing stops to allow growth while protecting your profits. The key is to avoid greed. Take profits strategically and don't let a winning trade slip back into the red. Earn the right to trade bigger. In trading, growth is earned, not given. As you develop consistency and confidence, you'll earn the right to increase your position sizes. Too many traders rush this process, increasing their size too quickly after a few wins, leading to big losses that can wipe out their gains. How many times have you done this yourself? In order to trade bigger, you must first prove that you, as a trader, can follow your trading plan, stay disciplined, manage risk effectively. When you demonstrate consistency over a large number of trades, scaling up becomes a natural progression. Always scale with discipline, not emotion, ensuring that even your larger trades align with your risk management principles. All of this stuff that I'm talking about right now, guys, I've talked about it in the previous week 10 video, week 11 video. All of this. This is just the most important aspects that have helped me over the years to becoming consistent, to becoming profitable, and longevity is really the key point. One of the most overlooked ones right here is master your trading psychology. Psychology is the most overlooked yet crucial aspect of trading success. It's not enough to have technical skills. You need the mental resilience to handle the emotional ups and downs of the market. Fear and greed can drive impulsive decisions. To master your mindset, you must do this. Stay calm and focused whether you're winning or losing. Develop the discipline to stick to your plan regardless of your emotions. Trust the process and avoid revenge trading after a loss or overconfidence after a win. In the early days, I often let emotions dictate my trades, which led to unnecessary losses. Over time, I learned that mastering my mindset was just as important as mastering the charts. The ability to stay emotionally neutral, whether you're on a winning streak or in a drawdown, is the key to long-term success. This is why I make my trading very black and white. It's literally what I talked about again, week 10, week 11. Make your trading very black and white. If you make it very black and white, it takes away the emotions of trading. Next, focus on consistent, small gains. Don't swing for home runs. One of the biggest mistakes new traders make is trying to score massive wins in a single trade. They over-leverage and take unnecessary risk, hoping for a big score. But successful trading isn't about hitting home runs. It's about consistently building small and manageable profits over time. By focusing on incremental, steady growth, you reduce emotional pressure and avoid catastrophic losses. This slow and steady approach compounds your account balance, helping you increase position sizes gradually and responsibly. Remember, trading is a marathon, not a sprint. Small wins accumulate into big results over time. Aim for singles. Home runs will come naturally. Chasing home runs every time is a recipe for burnout. The key to long-term success is to aim for singles, smaller, lower risk trades that keep you in the game. Home runs will happen, but they come when you least expect it and when you're executing a consistent, disciplined strategy. Think of it like baseball. Focus on making solid contact with the ball, and eventually the conditions will align for a home run. The market will naturally present bigger opportunities when you're prepared and trading consistently. So let your strategy work for you. Don't force big wins. They'll come when you've mastered the fundamentals. Consistency is the foundation for confidence and control. Consistency is the bedrock of successful trading. The goal isn't to win every trade, but to follow your strategy consistently. When you have a structured, repeatable process. It builds confidence and gives you control over your trades and emotions. With consistency, you create predictability, not in the market, but in your actions and outcomes. This reduces stress, allowing you to remain calm in volatile conditions. As you become more consistent, your confidence in your decisions grows, which in turn improves your trading performance. Consistency, confidence, and control are the cornerstones of sustainable long-term trading success. Don't overanalyze, act decisively, or risk missing opportunities. In trading, overanalyzing can lead to paralysis. The more you dissect a trade, the more likely you are to hesitate, second guess yourself, or miss the opportunity altogether. Trading rewards those who can make confident, timely decisions based on their strategy, not those who dwell in indecision. Hesitation often stems from fear of losing or being wrong. But in trading, fear leads to missed opportunities and losses. Once you've done your analysis and your strategy signals a trade, act without hesitation. Trust your process, execute your plan, and avoid overthinking. In trading, hesitation means missed profit. Develop your unique trading style. Don't copy others. Trading is a deeply personal journey. What works for one trader may not work for another, and trying to mimic someone else's style is a shortcut to failure. The key to success is to develop your trading approach that aligns with your personality, risk tolerance, and strength. Many traders fail because they try to adopt strategies that don't suit their natural instincts. Instead of copying others, focus on understanding yourself, your preferences, risk appetite, and trading temperament. Tailor your strategy to your unique qualities, whether you're a conservative or an aggressive trader. Remember, your edge in the market comes from being true to yourself, not to someone else. Building a strong foundation. These 11 principles that I just talked about, guys, have provided me a comprehensive roadmap for long-term trading success. Whether you're focusing on making small, consistent gains or developing your own unique trading style, the goal is the same: to build sustainable, disciplined approach that allows you to thrive in the markets over the long term. So, very simple, guys. Just follow these principles, master them. These are going to be so important in your trading journey. I literally just gave you an entire blueprint to the keys to success for the last over 10 years of what I've been doing. All right. Now, this is one thing. To master the principles is one thing. But now you have to understand that there are always going to be probabilities. And you need to understand the probabilities within trading. So let's get into it here. So probabilities in day trading. So number one, trading is a game of probabilities, not certainties. In day trading, there are no guarantees. No matter how perfect the setup looks or how strong the indicators are, there is always a chance the market will move in the opposite direction of your trade. This is where probabilities come into play. Every time you take a trade, you are essentially making a bet on the probability of a specific outcome based on your analysis. You aren't saying this trade will win, but rather there's a higher probability that this trade will work out based on my strategy. Now, key takeaway here is you're working with probabilities, not certainties. This mindset shift will allow you to stay calm and composed even when trades don't go your way. Secondly, edge in trading, finding high probability setups. Having a trading edge means that over a large sample of trades, your strategy will produce more winning trades than losing ones, or at least allow you to make more on your winners than you lose on your losing trades. This doesn't mean you'll win every trade. In fact, even a great strategy might only win 50 to 60% of the time. What matters is how you manage those winning and losing trades. Finding high probability setups is the goal. High probability setups are patterns, indicators, or signals that have proven over time to have a higher chance of working out in your favor. They don't work 100% of the time, but they give you an edge in the market. Example, let's say your strategy shows that a certain chart pattern, let's say a flag or a head and shoulders, leads to profitable trades 65% of the time. This is a high probability setup, but remember, it's still just a probability. The key takeaway here is your edge is defined by how consistently you can identify and trade high probability setups and then manage your risk accordingly to them. Number 3, the importance of risk to reward ratio. Probabilities alone aren't enough. You need to pair them with a solid risk to reward ratio to truly maximize your edge. Even if you only win 40% of your trades, if your winners are significantly larger than your losers, you can still be a highly profitable trader. So for example, if you risk $100 on a trade, but you aim to make $300, obviously that's a 3-to-1 risk to reward ratio, you only need to win 1 out of every 3 trades to break even. With probabilities in your favor, the winners will make up for the losses. The key takeaway here is to combine probabilities with a solid risk to reward ratio. Don't just focus on the percentage of winning trades, but also on how much you stand to gain versus what you could lose. Number 4, understanding losing streaks, part of the probability game. Even with a high probability strategy, losing streaks are inevitable. It's essential to understand that a string of losses doesn't mean your strategy is flawed. It's simply part of the probability game, just like rolling dice. You can land on several losing trades in a row, even when trading with an edge. What's important is how you handle those losses. Traders who don't understand probabilities often get discouraged, lose confidence in their system, or worse, abandon the entire strategy after a few losses. This is where discipline comes into play. Remember, even the best strategies will encounter periods of drawdown. It's not about avoiding losses, it's about managing them. As long as your strategy has a positive expectancy, meaning over the long run it produces net gains, you'll come out profitable. Key takeaway is accept losing streaks as part of the process. Keep your risk management tight and focus on the bigger picture. Probabilities and emotional control. One of the biggest challenges traders face is emotional roller coaster that comes with wins and losses. When traders don't understand probabilities, they tend to tie their emotions to each outcome of each individual trade. A losing trade becomes a personal failure, and a winning trade feels like a victory. This emotional attachment can lead to irrational decisions like revenge trading and over leveraging. When you view trading through the lens of probabilities, you detach emotionally from each trade. You realize that a losing trade isn't a reflection of your ability, but simply one outcome in a series of trades. Your focus shifts to following your process and managing risk rather than fixating on short-term outcome. Key takeaway here is understanding probabilities allows you to stay emotionally neutral keeping you disciplined and focused on executing your plan rather than reacting impulsively. How to apply probabilities in your trading. To successfully apply probabilities in your day trading, here are some actionable steps you can take. Backtest your strategy. Obviously, use historical data to see how often your setup works and under what conditions. This will give you a clear idea of probabilities involved. This is probably one of the most important things. Backtest your strategy. Backtest the strategy. Okay, this is what gives you the historical data that you need in order to know and have the confidence that it's going to be okay and essentially work out over the long haul. Maintain a trading journal. Track your trades and review them regularly. Over time, you'll see patterns that reveal how well your strategy performs and where you can improve. What did I talk about last week with trading journal? Same thing, guys. All right. This is so important that most of you don't do it. Use risk management. Always trade with a predefined stop loss and target that gives you a favorable risk to reward ratio. This way, even if you lose more trades than you win, your winners will outweigh your losses. Stay consistent. Don't jump from strategy to strategy after a few losses. Stick to your plan and trust the probabilities over a large sample of trades. Finally, guys, trust the process, not each individual trade. Day trading is not about predicting what will happen next in the market. It's about managing risk and playing the probability game. Each trade is just one in a long series of trades that over time will lead to success if you follow your strategy, manage risk, and keep your emotions in check. By understanding that trading is a game of probabilities, you'll approach the markets with a more strategic mindset, avoid emotional pitfalls, and focus on the long-term growth of your trading account. My final thought on this, guys, is embrace the uncertainty, manage your risk, and trust that the probabilities will work out in your favor over time. That's the real secret to long-term success in day trading. You guys picked a very hard career path to go down. All right, it takes a lot of work, but this video sharing with you the keys to success and the probabilities are the two main components, guys, that you need to understand first. So with that being said, I hope that this video brought you some value and it gave you some additional knowledge that you did not have before, guys. As always, guys, check out the playlist if you have not watched any of the videos. Obviously, if you've already watched the videos and you missed something, go back to the videos themselves. I hope the last 12 videos have brought you some value and hopefully something that you could have used towards your own strategy. Or if you chose to trade this strategy, that's perfectly fine. Let me know in the comments below, guys, of this video. Have you guys thought about probabilities before? Do you use it in your own trading? What part of the keys to success that we talked about today are you using yourself in your own trading? Until next time, guys, have a good rest of the week.